Every time prices climb, whether it's at the grocery store, the gas pump, or your rent, it's as if you're slowly losing control over your financial freedom. You're working hard, but the value of your paycheck seems to shrink every time you check it. You may be thinking it's just bad luck or a temporary issue, but the truth is, you're watching one of the oldest economic processes play out, a process that quietly transfers wealth from the many to the few. This phenomenon is called inflation, and it doesn't just raise prices, it reshapes the financial landscape, benefiting some while leaving many others behind. Inflation isn't some random event that happens to us. It is a financial tool designed to help those at the top maintain and even increase their wealth. For the wealthy, inflation isn't a problem to solve, it's an opportunity to grow their assets. But for the rest of us, it often feels like a never-ending struggle to keep up. The rising costs of living make it harder for those without substantial assets to save, invest, or build wealth. The real untold story of inflation is that it doesn't just make things more expensive, it redistributes wealth, and the people who benefit from this redistribution are typically the ones who already have the most to begin with. The rich use inflation as a mechanism that allows their wealth to grow, while the rest of the population is left behind, watching their savings erode and their purchasing power decline. To understand how inflation works in favor of the wealthy, we need to look back at history. For centuries, most countries' economies were tied to gold. Money was backed by precious metals stored in vaults, and this kept money scarce and stable. The gold standard made it difficult for governments to just print money whenever they needed it. If a government ran a deficit, it had to either raise taxes or cut spending to balance the budget. In times of crisis, governments often had no choice but to either reduce the debt through painful austerity measures or face the consequences of inflation. Inflation in those times was not the tool it is today. It was often a result of war, economic collapse, or a loss of monetary discipline. The idea that a government would purposefully create inflation would have been unthinkable. Inflation was seen as an emergency, something that needed to be controlled at all costs. But everything changed in the 20th century. The Great Depression of the 1913 was a turning point. The global economy froze, not due to inflation, but because of deflation. Prices fell, wages collapsed, and businesses failed. When money gains value over time, people hold on to it, waiting for the price of goods to decrease. This meant that the economy stagnated, debt became harder to pay, and businesses couldn't operate. The Depression revealed that a stable monetary system could easily fall apart if the economy wasn't managed carefully. This crisis led to a shift in how policymakers viewed money. The world saw that deflation was just as dangerous as inflation, if not worse. Instead of looking at inflation as a negative force, governments and economists began to recognize it as a potential tool, one that could help stabilize economies by encouraging spending and investing rather than hoarding. After World War II, nations were left with massive debt. Some countries owed more than 200% of their GDP. They couldn't possibly pay back these debts in full. But rather than resorting to austerity or cutting services, many governments turned to inflation to manage the situation. By allowing inflation to gradually reduce the value of their debts, governments could lower their real debt burden without making difficult political decisions like raising taxes. In the 1950s and 1960s, inflation began to be used as a way to ease national debts without the public noticing. The value of money slowly decreased, and with it, the real value of government debt shrank. For the wealthy, this was a win. As inflation eroded the value of debt, their investments, such as real estate, stocks, and businesses, grew in value. What seemed like a national emergency for some became a lucrative financial strategy for others. Then came 1971. President Nixon made a decisive move by closing the gold window, ending the dollar's convertibility into gold. This event marked the beginning of a new era. Money was no longer tied to any tangible commodity, but rather to the faith and confidence of the public. The dollar became an instrument of policy, and governments could now create money without limits. The ability to print money at will had profound implications for how inflation worked. It was no longer a random occurrence, it became a carefully managed tool for economic control. With the dollar no longer tied to gold, inflation became a deliberate feature of the economy. Governments could print money to pay off debts, fund wars, and keep the economy moving forward without raising taxes or cutting spending. But there was a catch. Inflation doesn't affect everyone equally. Those who already own significant assets like land, real estate, and stocks found that their wealth increased as the value of money decreased. For the wealthy, inflation works like a powerful wealth amplifier. When the value of money decreases, the value of their assets, property, stocks, bonds, tends to increase. So, while ordinary people are struggling to keep up with rising costs, the rich are watching their portfolios grow. This is why inflation is often referred to as the silent tax, because it's invisible to many. But it works in favor of those who understand how to leverage it. Inflation has another crucial impact. It benefits borrowers, not savers. If you hold debt, inflation makes it easier to repay. A mortgage that seemed insurmountable today might feel much easier to manage in the future, as the real value of that debt decreases. For example, someone with a fixed-rate mortgage will find that inflation gradually makes it easier to pay off their loan because the money they owe becomes less valuable over time. On the other hand, if you're a saver, inflation works against you. If you've been putting money in the bank, inflation quietly eats away at your savings. The money you've saved is worth less every year as prices rise. So, while the wealthy are leveraging inflation to grow their assets and reduce their liabilities, the average person finds their purchasing power eroding over time. The process behind this is known as the Cantillon effect, named after an 18th-century economist who observed that the first recipients of newly created money benefit the most. This idea remains true today. The rich, who are closest to the source of money creation, such as central banks or financial institutions, are the first to spend the new money before prices rise. By the time the new money reaches the general public, it's already diluted, and its value has decreased. This is how the wealthiest individuals, banks, corporations, hedge funds, are able to get a jump start on inflation. They're able to borrow cheaply and invest in assets that appreciate while the average person sees their wages struggle to keep up. The money that the government creates doesn't just circulate equally, it's distributed unevenly, benefiting those closest to the financial system. So, how does all this impact the average person? For the general public, inflation is a stealthy thief. Wages rarely keep up with rising prices. People watch as their grocery bills double, their rent increases, and their savings lose value. But inflation doesn't just affect the cost of living, it also shifts power in the economy. The system is rigged in favor of ownership, not labor. Inflation rewards those who own assets, and it penalizes those who rely on labor to earn money. People who save are punished because the value of their savings decreases each year. Those who own property, stocks, or other assets are rewarded because the value of those assets increases. In other words, the system is set up to transfer wealth upwards, from the poor to the wealthy, through the mechanism of inflation. Inflation isn't a glitch in the system, it is the system. It's the mechanism that keeps the economy growing, but it does so at the cost of the public. The rich don't fear inflation, they understand it. They know how to leverage debt and asset appreciation to come out ahead. They know that inflation is their silent partner, quietly growing their wealth year after year. So, the next time you hear that a little inflation is good for the economy, remember who it's really good for. It's not the worker saving for a house or the retiree living on a fixed income. It's the people who own the assets, the ones who built the system to make sure their wealth never stops rising. Inflation isn't a random occurrence. It is a deliberate tool of economic policy that sustains the wealthy, encourages risk, and punishes caution. It's the invisible engine of a debt-driven system, the silent tax that shifts wealth and redistributes power. And unless we understand how it works, we'll continue to watch as the same wealth transfer happens again and again, with the rich getting richer while the rest of us struggle to keep up.